important concept when learning about the difference between active and passive investing is what is a market index. So active investing means a portfolio manager is making choices about what stocks and bonds will go into a fund. But with passive investing, those decisions are not made. Portfolio manager simply invests in stocks that mirror an index. But what is a market index? When you hear on the radio the announcer saying the S&P 500 was down today, or the S&P TSX was up today, what they're talking about there is a market index. What they're insinuating is that the stocks in the US stock market were down today. But they're not referring to every single stock that's traded in the US. They're referring to an index of stocks. An index is a representation of a market. So the S&P 500, for example, invests in the 500 major companies in the US. And so when we say the S&P 500 was down today, we're saying those 500 stocks as a group traded down today. Now, you don't invest in an index. It's just a representation of the market. It's sort of like saying when you see survey results. So let's say, for example, we hear about consumer confidence in Canada. Well, the consumer confidence number is obviously not a reflection of how every single person in Canada is feeling. They've simply done a survey of, a couple thousand Canadians to find out how they're feeling about the economy and about their finances. And then they use that as, of course, a proxy for how all Canadians are feeling. So a market index works very much the same way. It's a way of measuring the return of a market. So when we talk about passive investing, what we're saying is that a fund, or say an exchange-traded fund or an index mutual fund, is simply investing in all of the stocks in an index in exactly the same proportion as the index reports them. So if you own a ETF that follows the S&P 500, it's going to own 500 stocks, the same 500 stocks that are held in the index. And similar for Canada or any other market. Every market in the world has its own index, and there are indices that track a whole bunch of other asset classes as well. So when you buy a passively managed exchange-traded fund, what you're actually buying is an investment that mirrors that index, and no one is making active decisions about which stocks to include and which stocks to exclude. And this is why passively managed exchange-traded funds have much lower fees than actively managed funds, because there's no decision-making and it's a lot easier. So I hope you have a better understanding of what an index is now and how it applies to passive investing.